candlesticks. As you can see, we got green and red candles here. When a candle is green, that means it opened and then went higher and finished the day higher. If you look up here, you'll see O for open, H for high, L for low, C for close. This is how many dollars it changed. This is how many percentage points it changed. All within one day. The D is for daily. So this is December of 2019. You can see here, this candle has a wick, that top piece, because it went pretty high during that day, then came back and closed lower, right? So it closed down there. It opened here, closed there. That's why it's red, because it closed lower than it opened. So we're going to do a playback, and I'm going to show you guys how people make money off of stocks. You bought stocks in December 2019 of Apple. We all know what Apple is. We all have Apple iPhones. Well, most of us at least. So if I play this, it's going to show you on a day-by-day basis what Apple stock did, right? So it's going up, it's going up, it's going up. Time is going by. You see, some days it goes down, it goes up, right? And you're a long-term investor, so you're just holding. You don't really mind the day-to-day price action. Then we get into 2020. Now you can see here, February of 2020, things are going smoothly. Remember, we were just here, so it came up a lot. Now it's starting to fall. This is when the pandemic happens. Things start to get out of control. Things get crazy. Right, so we'll speed up a little bit. The pandemic goes on. The price of the stock falls. You see how wild it gets. March of 2020 comes. People started buying stocks. So one thing you'll say is, how do you know when to buy? The only signalable action that I see here from the candles is this. It's called a pin bar or a hammer. It's a bullish reversal candle. When you have a long wick at the bottom, that means, remember, it opened here, closed here, but it went all the way down here during the day. So for it to come all the way back up, that is pretty bullish. That means people are expecting the stock to go up. They like this price. If it breaks above the highs of that day, then you expect it to continue. And that's what it does. This was the lowest point in 2020. So it continues and continues and continues. You'll see there are green and red days, but the overall trend is higher. Next, you'll see, as we get closer to today's date, right now we are in July of 2020. You see, it went up a lot in July of 2020. Went up a lot. September came and it came down pretty badly. It fell pretty badly. But remember, even from December of 2019, even after that big drop, you're still net positive on your position. Look how much it came up, from $65 to $136 at one point. Time goes on, time goes on. Time goes by. Stock price continues to go up and down, up and down. You'll see this blue line I have here connects points. Every time it falls, stock price touches that line and goes back up. Every time it falls, touches that line and then goes back up. Every time it falls, it gets near this line, touches that line, goes back up. And then bam, here we are today. That is how people make money off of stocks. They just buy and hold. Remember, they bought here. That's where we started. Your returns would have been, at this point, 117%. But at one point, you would have went down and been, from December of 2019, you would have been down 30%. What I like to do is go to a smaller time frame. So how each one of these candles represents one day. Now each candle represents 1 hour. Each of these white lines, these white dotted lines vertical, is showing me a new day. So each daily candle can be split into hourly candles, 30-minute candles, 15-minute candles. This is 1 hour of price action. When you see a gap down, see how the day before it was all the way up here? Then it started the new day way down here. You can buy puts and you can make money on it going down. You can buy calls when you see a reversal candle like we just talked about on the daily chart. In March of 2020, we see one on the hourly. Today, you could have bought calls once it went up. That's a 50% move if you choose the right contracts. How you choose your contracts depends on how aggressive you want to be. The sooner the contracts expire, the more aggressive and more volatile they're going to be. So if you're wrong, you lose money. If you're right, you make money. You would enter on a break of this reversal candle. So you would enter as soon as this broke above, and you would take profit, most likely here, or just set a trailing stop loss just in case it did run. You maximize your profit. If the trade were to fail, you would know because it would break, go below. You'd most likely set your stop loss below a break of this candle. The price of that candle here, the low, the L, is your stop loss below 155.98. Your entry is above the highs, so above 157.21. And that's just how you look at candles. You can break these hourly candles down into 15-minute candles. So these are those same hourly candles broken down into 15-minute candles. This is where that reversal candle was formed. Right, so right up in here, and you play the breakout, and you ride it up. That's how you make money. That's how you explain candles. That's how you read candles. You look for different shapes. You look for different patterns. You look for different trend lines. All the candles tell a story. All these candles tell a story. And that's long-term investing, and that is trading. And a brief summary showing you guys candles. And we can do a quick playback on how we see candles live in action. So, going back to yesterday, as if today hasn't happened yet. That's the last candle for March 9th. Then the new day starts and is way down there. You could trade puts on a break below this level, and your stop loss will be there. Puts mean you are betting that the stock goes down, and you could just ride it out. You probably want to start taking profit here because you see support from the previous day there, or like I said, set a trailing stop so you can try to maximize your profit in case it does keep going down. Your contract will stay open, but if it does reverse and go higher, then your contracts will automatically close based on the price that you are willing to take. So if I'm up 15% here, I'm going to set a trailing stop loss at maybe 3 to 5%. That way, if it shoots back up, then I'll only lose 3 to 5% of my profit. But if it keeps going down, then I'll make even more money. And no matter how low it goes, how profitable I get, it'll trigger that trailing stop loss as soon as I lose 3%. So I can be up 15%, set a trailing stop, and it come down. Now I'm up 25%. But as soon as I lose 3%, my sell order would trigger right up in here. Instead of me selling here for 15%, I gained another 10% with this fall. My trailing stop loss is still open, and once this starts to bounce, I'm up 25% here. It sells for me at 22% profit, and that's how I like to use trailing stop losses as well. So we talked about a lot in this scenario. How I would know to buy puts would be because we were bearish on the day. We got down and we broke below this. If somebody tried to play calls, you would have never got in because you would have never had a signal to go long. And that's how you do it.